The Japanese yen is initially shaking gently, then violently. One of the world's most stable currencies is falling to values not seen in many decades. Behind that drop is a storm of politics, power struggles, and rising worldwide stress. This is not simply another market downturn. This is an alert coming from the core of East Asia, and it is flashing red for the whole planet. When we say the yen is collapsing, we do not mean it has vanished or instantly become worthless. A currency collapse here means Japan's money is quickly losing value compared to major global currencies, like the US dollar. This makes everything Japan imports from other nations more costly: fuel, food, technology. At the same time, it changes how investors, governments, and rival economies react. The issue is not just economic, it is tactical. Because when a major economy weakens, others do not just observe, they respond. And China is responding. While Japan struggles to protect its currency, Beijing is sending clear warnings, not with military force, but with financial signs, rule changes, and quiet actions within the worldwide money system. Behind the scenes, China is working to lower its reliance on the dollar and challenge the power of the G7 financial setup. This makes the yen's drop more than a local issue. It becomes part of a bigger fight for control over the future of global money. Here is what many people are missing. A weaker yen helps Japanese exports, but it hurts Japanese families. Prices go up, wages struggle to keep pace, and living costs become heavier. Also, Japanese businesses that rely on foreign supplies pay more. This creates pressure inside Japan, political pressure, social pressure. And when pressure builds inside a major economy, it affects its choices abroad. This is where global politics fits in. Now, connect this to China. Beijing has spent years creating its own trade systems, payment methods, and currency influence across Asia, Africa, and parts of Europe. As Japan's currency weakens, China sees a chance not just to gain an economic edge, but to reshape how money flows worldwide. This is not being done with loud announcements. It is happening through slow policy shifts, trade agreements, and financial adjustments that most people never hear about. In this piece, you will find out why the Japanese yen is falling and what forces are pushing its value down. You will grasp how China is reacting in the background and why its moves are starting to worry global powers. You will also see how this situation could affect global trade, energy prices, investments, and even the value of currencies far from Asia. Most importantly, you will discover how this connects to a larger shift in the global financial system, where power is slowly moving away from traditional Western dominance. There is one reason to follow this until the very end. The final section reveals the possible future outcomes of this situation. Not just one, but 3 realistic ways the world could go if this currency conflict keeps growing. Each path carries very different results, not just for Japan and China, but for everyone tied to the global economy. If global finance, hidden power struggles, and real-world economic changes interest you, then this information is for you. Stay with us, because this story is still developing, and the next steps could change the financial balance of the world. Welcome to our platform, where we explain complicated global events simply and effectively. If you want to stay informed about global politics, economics, and the forces shaping the future, be sure to subscribe and join our growing audience. For years, Japan followed a very different course from the rest of the world regarding interest rates. While other central banks increased borrowing costs to control rising prices, the Bank of Japan kept its rates near zero. Sometimes they were even negative. The goal was straightforward: push money into the economy, encourage people to spend instead of saving, push companies to invest instead of keeping cash. But this long-term approach created deep side effects. It made the yen less appealing to worldwide investors. When investors can earn higher profits in the US or Europe, money leaves Japan. As that money goes, the yen weakens even more. This policy did not appear out of nowhere. It came from Japan's long fight with falling prices, deflation. For decades after the asset bubble broke in the early 1990s, prices barely went up. Sometimes they even dropped. Companies made less. Consumers delayed purchases, waiting for prices to fall again. Economic growth slowed, wages stayed the same. The whole economy entered a cycle where low demand led to slow growth, and slow growth strengthened weak demand. The central bank tried to break this pattern by flooding the system with cheap money. But the deeper problem was the basic structure. An aging population, fewer births, and a shrinking workforce all reduced long-term economic speed. Now, another issue has appeared: rising prices, inflation, but not the healthy type caused by strong domestic demand. Much of Japan's recent inflation comes from outside because the yen is weak. The country now pays more for imported energy, food, and raw materials. Oil gets more expensive, gas prices climb, basic goods cost more. This pushes up overall living expenses even though wages do not rise at the same speed. The result is pressure on families and small businesses. International groups have noted a tough balance. A weak yen makes Japanese exports more competitive. Cars, electronics, and machines become cheaper for foreign buyers. This helps big exporters and boosts foreign earnings. But at the same time, it raises the cost of living inside Japan and increases financial risk. If global investors lose faith, the currency could weaken further. That would increase import inflation, push debt costs higher over time, and limit Japan's future policy choices. The central bank is now caught between two fires: protect growth or protect the currency. Knowing that each action carries a penalty, the yen has been falling with a speed that has surprised even experienced market observers. It has reached values that were once thought impossible for a major developed economy. What makes this more risky is not just how low it has dropped, but how unstable its movement has become. Some days it falls sharply, then recovers, only to drop again. This kind of up and down movement tells a deeper story. Investors are no longer sure what the lowest point is. They do not trust that the current value is the bottom. When a currency starts acting like this, faith becomes shaky. And in global finance, faith is everything. Japanese officials have not remained quiet. In recent months, government leaders have openly warned that they are ready to step into the market if the drop becomes disorderly. This is called foreign exchange intervention. It means selling foreign money reserves like US dollars to buy yen and support its value. Japan has done this before, but they do not like to do it often. It is costly. It uses up national reserves, and it only works for a short time if the basic economic forces remain unchanged. The warnings are meant to send a message not only to traders, but also to speculators who try to gain profit by pushing the yen lower. At the same time, the Bank of Japan has started changing its tune. For years, it refused to even discuss increasing interest rates. Now its language is shifting. Officials are carefully suggesting that a rate increase may happen if price pressures and currency weakness continue. But this is not a simple choice. Raising rates could strengthen the yen by attracting more foreign investment. However, it could also slow down Japan's fragile economy and increase the cost of borrowing for businesses and the government, which already has huge debt. This leaves Japan trapped in a small space. Move too slowly, and the yen keeps sinking. Move too quickly, and the economy could stop growing again. Meanwhile, global investors are watching every speech, every policy announcement, every small hint. Even one sentence from a central bank official can move the yen in seconds. The result is a currency caught between market fear, political demands, and the fear of making the wrong move at the wrong time. As the yen weakens, analysts are watching closely how China might react in currency markets. Weakness in one major Asian economy can provide cover for another. A cheaper yen makes Japanese exports more competitive. To protect its own industries, Beijing may let the yuan weaken as well, not through a sudden large drop, but through slow, managed changes. This keeps Chinese goods appealing in global markets without causing panic. It is a quiet plan, one that does not rely on news headlines, but on steady pressure through money tools and policy signals. This behavior is not new. China and Japan have a long history of watching each other closely on currency issues. When one adjusts, the other often reacts. In the past, times when the yen was weak have sometimes been followed by softer yuan policies, not always openly, but subtly through market guidance and exchange rate limits. This raises the danger of competitive devaluation, where countries lower their currencies to gain a trade advantage. The risk is that once this cycle starts, it becomes hard to stop. Each move forces a response. Each fall encourages another. Behind this technical currency battle is a much bigger goal. China is not only focused on trade competition. It has spent years building parallel financial structures, from expanding its own payment systems to promoting the use of the yuan in international trade agreements, especially in energy and raw materials. It is strengthening regional financial ties across Asia, the Middle East, and parts of Africa. Many of these deals reduce reliance on traditional Western-controlled financial channels. This is not accidental. It is a long-term effort to shift influence. A weaker yen makes it easier for China to push this plan. Japan, once Asia's financial leader, now finds itself under pressure. Regional partners see Beijing as more stable compared to Tokyo's currency uncertainty. This changes talks. It changes trade flows. It changes financial loyalty. Quietly, step by step, it alters the balance of economic power in the region without needing a single formal announcement. When people talk about turning over the G7 system, they are not talking about a sudden takeover. They are talking about a slow shift in how global money power is shared. For decades, the G7 nations controlled most of the rules, institutions, and flow of global finance. Their currencies dominated trade reserves and international loans. Turning over that system means reducing this reliance and building alternatives that work outside that traditional group. China is using its regional influence and currency power to move in that direction step by step. Currency power means using the value, stability, and movement of your own currency as a tool of influence. When China signs trade agreements where payments are settled in yuan instead of US dollars, it reduces the role of Western financial systems. When it encourages central banks in Asia and beyond to hold more yuan in their reserves, it slowly increases its role in the global reserve system. These moves may seem small on their own, but together they create a new level of financial power that does not entirely pass through the G7 system. Historically, the major powers have tried to avoid open currency conflicts. G7 nations have often released joint statements urging countries not to deliberately weaken their currencies for trade benefits. These agreements were meant to prevent economic disaster, like in the 1930s when competitive devaluations made the global depression worse. But as the world becomes more separated, these old agreements are weakening. Emerging powers do not always follow rules that they did not help create. China's ambition goes beyond trade and reserves. It is investing heavily in regional financial structures, cross-border payment networks, digital currency trials, bilateral swap deals with central banks across Asia and other regions. These tools let countries trade and finalize deals without going through traditional Western banking systems. Over time, this creates a parallel structure. The risk here is increasing separation. Instead of one connected global financial system, there may be several competing ones. If currency tensions rise, this could become a new kind of currency war, not fought with rapid devaluations alone, but through influence, partnerships, and alternative networks that slowly divide the global financial order into groups. Inside Japan, the weakest point in this situation is not the corporations or the banks. It is the average family. A cheaper yen means everything imported becomes more costly. Energy bills rise because Japan relies heavily on foreign fuel. Food prices climb because large parts of farming products and animal feed are imported. Even basic daily goods see slow but steady price increases for families whose wages have barely moved for years. This creates quiet financial stress. Savings lose buying power. Monthly costs become tighter. The pressure builds, not suddenly, but silently. And that is what makes it risky for the broader Japanese economy. The tools available to fight this weakness come with high costs. Currency intervention requires using foreign reserves, which are not limitless. If the government steps in too often, markets may start to test its boundaries. Each wave of intervention can calm markets for a moment, but it also increases sudden changes if traders start betting against future actions. This becomes a cycle where stability is harder to keep. Meanwhile, higher interest rates, if brought in too quickly, could slow corporate investment and increase the burden of Japan's massive public debt. The effect does not stay within Japan's borders. Asia is strongly connected through trade, supply lines, and financial flows. A falling yen affects exporters and importers across the region. Some economies benefit from a weaker rival. Others suffer because their own currencies are pulled into the disorder. Global investors, sensing uncertainty, may pull money out of Asian markets into safer assets, increasing pressure on developing economies and their currencies. This kind of movement spreads faster than news headlines. It can destabilize entire markets in days. On a strategic level, the shift is even more serious. As Japan struggles to stabilize its currency, China gains power, not through force, but through opportunity. Financial weakness becomes diplomatic weakness. Trade talks change. Regional partners adjust their plans. Power balances shift. Quietly, Japan finds itself more defensive, while China finds itself moving ahead in a system where economic strength defines influence. One possible path is that Japan acts firmly. The government steps into the currency market, and the central bank finally raises interest rates with confidence. This sends a strong message. Investors see higher returns in Japanese assets, capital starts flowing back in, the yen stabilizes, sudden changes calm down, import prices stop rising at the same speed, families feel a little less pressure. But even in this case, the cost is high. Higher rates increase borrowing costs for businesses. Government debt becomes more expensive to manage. Economic growth slows before it finds a new balance. Stability is achieved, but at the price of short-term difficulty and long-term adjustments. Another path is more disorderly. Japan delays its response. The yen continues to fall. Rising prices deepen because imports keep getting more expensive. Energy costs remain high, food prices keep rising, wages fail to keep up, public frustration grows, political pressure increases, global investors begin to view Japan as a basic risk rather than a safe developed economy. This increases the sudden changes. Speculators target the currency even more strongly. At the same time, regional partners start changing their policies to protect themselves from Japan's instability. This creates wider financial stress across Asia. Global political risk increases because economic weakness reduces Japan's strategic options in the region. Then there is the third path, the most sensitive one. China decides to act more strongly. It allows the yuan to weaken along with the yen, or uses financial tools to expand its influence further. Regional partners are offered trade benefits settled in yuan. Financial agreements bypass traditional Western channels. Quiet pressure is put on smaller economies to align with Chinese systems. This shifts the balance, not quickly, but steadily. Japan, already pressured by a weak currency, faces a shrinking area of influence. Global markets sense a fundamental change. Instead of one connected financial system, rival groups start to solidify. Trade flows begin to readjust around these groups. Investors are forced to choose sides. Each of these paths does not exist alone. They overlap. They affect one another. The final direction depends on decisions made in quiet central bank rooms and behind closed political doors, far from public view. The fall of the yen is not just a story about numbers on a currency chart. It is a story about power, pressure, and position. Japan is not only fighting rising prices or defending its exchange rate. It is defending its place in a changing world order. At the same time, China is not only managing its own economy, it is testing how far it can push its influence inside a financial system that was built without it. This is why the falling yen is not a local issue. It is a global political signal. For decades, global finance moved around a few powerful centers. The rules were mostly written and carried out by the same group of nations. Now, that balance is starting to shift. A weak yen, slow policy responses, and China's growing financial reach are all connected to a much bigger change. This could become a turning point, not because one currency is falling, but because the structure around global money, trade, and influence is slowly being reshaped in real time. What happens next depends on a few key actions. Watch the next Bank of Japan policy meetings and whether interest rates finally rise in a significant way. Watch how China manages the yuan and whether it keeps building trade and payment systems outside the traditional Western setup. Watch how the G7 responds. Will it cooperate again like in the past? Or will each country act alone in a more divided world? These are not small events. They will decide how money flows, how power shifts, and how stable the global economy stays in the coming years.